In this video, we'll look at 9 rules of investing. These distill what I've learned over the course of my own investment journey, but also draws on what I've learned from our investment community and also my one-to-one coaching clients. So hopefully there's something in this video for everyone. Now, if you do enjoy our content, please do like this video and subscribe to our channel. Let's start with rule number 1, invest for financial goals. I often find that people just launch into investing without thinking about why they're investing, which is kind of pointless because if you don't know where you're headed, it's difficult to plan a route to that destination. Now, what do I mean by your goals? Well, it's really what you want to achieve with your life, and money is just a tool to get you to where you want to be. For example, do you want to study? Do you want to travel? Do you want to retire early? Maybe you want to eliminate your debt. Or perhaps you're tired of your career and you want to change and you have to fund that change. Maybe you want to get married, or you want to be more tax efficient. Or maybe you want to leave money to people who aren't in your family. You want to do philanthropy. Whatever your goals, I think that forms your core of your financial plan. And that also structures what it is you buy and your investment mindset. So start with those goals and then work back to your portfolio and how you manage it. Rule number 2, keep it simple. Now, people are often amazed that my core portfolio is just one fund, one global equity fund. In fact, it's a developed market fund. But they assume that because I've got a background in finance, it's going to be really complex. Lots of stocks, lots of bonds, something that's really difficult to manage. But in fact, what I've found over time is I really embrace simplicity, and I just wish I'd have done this sooner. It's really easy to manage. I know exactly what's in my portfolio. I can look up its returns very easily, just one fund after all, and the maintenance is non-existent. All I can really do is put more money in, and that makes it very simple. I'm never trying to second guess myself and think, should I have put more into this or that? Furthermore, if I were to pass away and someone's going to inherit this portfolio, it'll be very simple to understand. Now, I do have a fund portfolio which has 10% of my money in it, which is complex and changing all the time. But I make sure to keep that very much contained, self-contained, and away from my core. And my core is very simple. Now, one fund isn't appropriate for almost all people. It's better to have some safe investments alongside your equity. So having a 2-fund portfolio makes sense for most people. And early on in the history of my channel, I made a video called How to Build a 2-Fund Portfolio. And then later on, you probably guessed it, I thought about making a 3-fund portfolio where you maybe want to diversify with things like commodities. But 2's probably enough for most people. Rule number 3, keep fees low. One way to think about fees and reducing them is that if you do reduce them, it's like a guaranteed return forever. So let's say you're paying a fee for something and it's fairly high, say it's 1%. Now, stock returns, as we'll see in a moment, on average are maybe 5 or 6% a year. Let's call it 5. If you're paying a 1% fee, then you're giving away 1/5 of your returns. Now, the finance industry is doing very well, thank you very much. They don't need the additional money, so keep that for yourself. So it really pays to squeeze those fees down as low as you can. What are the fees that you'll have to pay? Well, you pay fees for funds. So by buying cheap funds, you can minimize that fee. A fee of more than 0.2% for any fund per year, I think, is excessive. It would have to be very special indeed. You'll pay a platform fee. That can be a percentage or a fixed amount. If you have a large amount to invest, the fixed amount is probably better. And if you have a small amount to invest, the percentage fee might be better. You'll also pay trading fees on some platforms. Although many platforms nowadays are commission free, you may still have to pay for currency conversions. So again, by trading less, it's under your control how much you pay for those fees. And then finally, there are fees for advice. Now, those tend to be quite high. It depends on the advisor, but it's also a percentage fee. So if you do have a large amount invested, that can end up being very expensive indeed. That's not to say you shouldn't get advice, far from it, but just be wary of how much it can cost you over the long term. And fees of 1% or even higher are going to eat away at that return. Rule number 4, no expected returns. Now you're probably thinking, Ramin, you don't know what the returns are going to be. Well, over the long term, you kind of do, because returns become more predictable. So when I'm talking about knowing what returns to expect, I'm talking about long-term returns. And you'll probably have seen me using this data from Dimson, Marsh and Staunton from the old Credit Suisse Global Returns Yearbook. Now what this did was to track US stock returns and UK stock returns relative to inflation in the US and the UK, but also tracked returns for bonds and for bills, which are like money market funds. Now what's astonishing is that over this 122-year period from 1900 onwards, stocks beat inflation by a massive 5 or 6%, depending on whether you were in the UK or in the US. If you put money into bonds, you'd have earned a staggering 4% less per year on average. And if you put money into cash or money market funds, another percentage point would be lost per year. Now these are just averages. Over shorter periods of time, your outcome will be very different, of course. But if you are a long-term investor, these are the numbers you should anchor on. These are what you should expect, and deviations from these are caused by things like macroeconomics, valuation, but always come back to these long-term averages, because a lot of asset allocation hinges on these numbers. Rule number 5, know yourself. Now there are two aspects of your character which are critical to investment. The first one is your risk capacity. Now that's your economic capacity for loss. In other words, if stocks were to lose 40% tomorrow, would that affect the quality of your life? If your investments are money that you're not going to touch for decades, well, it wouldn't affect you at all. So your economic capacity for loss in that case would be very high. Whereas if you're in retirement and stocks fall 40%, then it may well affect your standard of living after that crash, because you won't want to sell stocks after they've suffered such a huge fall. In that case, you'd have been wishing that you'd not had so much risk in your portfolio in the first place. There's another aspect to your character and your approach to investment, which is called risk appetite. Now, this is about your emotional capacity for loss. You may well be able to weather a 40% fall in equity, but if you're not sleeping at night, that's no way to live, and that's the wrong portfolio. So in determining how much risk to take in your portfolio, visualize one of these 40% sell-offs, which happen every 10 to 15 years in equity. They always happen relative to the previous all-time high, but of course that's the number we anchor against. And then ask yourself, would I be able to weather that loss economically? And would I be able to weather that loss emotionally? And if the answer to either of those questions is no, then consider de-risking your portfolio. Now, of course, there's a trade-off here. We saw the average returns for stocks and bonds and cash. You will pay a penalty for that safety, but you don't want a portfolio that's not appropriate for you in terms of your risk capacity and your risk appetite. Now, if you did want to learn more about investing, you can do that as part of our investment community, which is now 1,000 people strong. And we've drawn together people with a similar mindset. They think about long-term investing, they diversify, but they also have fund portfolios, and we discuss all kinds of investments. Now, as a member, you get access to all kinds of goodies like these trackers, things like a gilt table, which shows you UK gilts. So here are the prices, the gross equivalent yields, but also things that help you plan your retirement, things like drawdown calculators. For example, one from Vanguard, another one based on work by Guyton and Klinger, another one from the Bogleheads forum. Plus, we have a members chat forum so that you can chat to other members of the community and benefit from their distilled wisdom, which for 1,000 people is very considerable indeed. To learn more about that, just go to pensioncraft.com/membership, and there'll be a link to that in the description below. Rule number 6 is about excitement. If investing is exciting, you're doing it wrong. Now, excitement is one of the red flags because that shows that you may be gambling. Remember, with gambling, you've got potentially very high rewards, which you could get very quickly, but you also get very high risks of loss. And that's why gambling is exciting. You get a huge adrenaline rush if you have a positive outcome, and then huge regrets and grief if you don't get a positive outcome and you have a big loss. Now, investment isn't like that, or at least it shouldn't be. Investment should be more like taking out the rubbish or washing up the dishes. It should just be something that you do in the background, maybe even automate it to reduce the friction. You can set up direct debits to feed into your investment account, and then you don't even have to think about it. And if you're checking your portfolio more than once a month, that's probably too much. Remember, short-term, high returns are not what you're trying to achieve. That's unlikely to succeed. And that brings us on to rule number 7, live long and prosper. Now, I'm not sure how that photograph made it onto this slide, but yes, I am a Trekkie. And yes, that is one of Spock's catchphrases, but I think it captures a really important aspect of investment, which is that stock markets are a way of transferring wealth from people who are impatient to those who are patient. What's most likely to work for most people is to get steady, fairly small returns for a long period of time. Previously, we saw that the average return above inflation for stocks in the US and the UK is around 5 or 6%. So let's say it's 5%. Well, over a decade, compounding really works in your favour. A pound invested at the beginning of that period will increase by 1.6 times. Over 20 years, that money will almost triple. Over 30 years, it'll roughly quadruple. And over a 40-year period, there's a staggering 7-fold increase in that money. So if you do look at your portfolio day to day, all you'll see is volatility, that daily fluctuation in the value of your fund, by around 2% if it's a stock portfolio. Over the long term, however, this drift upwards dominates. Volatility becomes much less relevant, and you'll see the huge power of compounding. So this is why a long-term mindset works. And in order to achieve that, you've got to live a long time. So stay healthy, and that way you can ensure that a reasonable return will be yours for a long period of time, and you'll get the full benefits of compounding. Rule number 8 is about keeping it tax efficient. Now in the UK, we have lots of very generous schemes that allow us not to pay capital gains tax and income tax. We've got the individual savings account, we've got the self-invested personal pension, and both of those allow you to compound your investments without having to pay tax. Now for the ISA, the tax is paid before the money goes into your ISA, so you don't have to pay it again on the way out when you take it out of the account. With the SIP, it's paid from your gross income, so you pay the tax when you withdraw it in retirement. So ideally, you'd put as much as you can into those two vehicles in order to minimize the tax that you pay, legally of course. Now I do see some people obsessing about tax, and I think that's a mistake. Use these structures, but don't let the tax tail wag the investment dog. That's probably a focus which is misplaced. Plus in the UK, I think the generosity of the ISA and the SIP in terms of how much you can put in and not having to pay tax on it means that if you do have to pay tax on a general investment account, I wouldn't begrudge that. And finally, rule number 9, have a flexible plan. Now there are certain elements of a plan which I think make a lot of sense. If you've got debt where you're paying a high interest rate, try and pay that off first before you start investing. Mortgages tend to be collateralized borrowing, so their rates tend to be lower. So there's not so much of a focus on paying off a mortgage, so people often invest alongside keeping a mortgage. After you've paid off your debt, you probably want to build up an emergency fund. That should be in a liquid form, which you can sell quickly and use quickly, and it should be kept in something which is cash-like. Maybe a money market fund, maybe short-term government bond funds, or maybe even cash. Life has emergencies, and you should be flexible in meeting those cash requirements. But then once you've gone beyond that, you should think about budgeting and saving. How much are you spending? How much are you earning? And how much can you actually put aside? I often see people whose wages increase the amount that they spend, so they're no better off. So this kind of lifestyle creep can be a problem when it comes to saving for the long term. Now in retirement, I think the 3 H's, and this is something I learned from Christine Benz's excellent book, How to Retire, are very useful. So what are the 3 H's? Have you had enough? In other words, have you had enough of your workplace? And are you ready to retire? Do you have enough? In other words, have you got enough money to retire? A lot of people find that quite hard to calculate. And then finally, will you have enough? Will you be able to fill your days with things that you enjoy? Or will you really end up pining for being back in the workplace? So have a plan for what you're going to do after you retire. Otherwise, you may find that if you're ill prepared, you don't have such a pleasant transformation of your life, and it becomes a bit of a shock, both for you and your family members who have to live with you. And then finally, think about your dependents and whether you should make a will. It's really a bad idea not to have one in place, no matter how young you are, because we never know what's going to happen. And it can cause real problems for your family if you don't have a will in place when you pass away. You may also want to have insurance in case something does happen to you. Now, I said it's a flexible plan. The point is that after you've made your plan, you should always revisit it as your circumstances change. You may have saved enough, you thought, but then it may be that you get a shortfall in your savings due to poor investment returns. Or perhaps you've saved too much and you can actually start spending more of your money, which would be great news. But if you don't measure it, you won't know. And if you don't have goals, you won't know if you've got too much or too little to achieve those goals. So I hope those 9 rules have been helpful for you as well. I've certainly learnt a lot from having the community and talking to people every day about investment. Now remember, if you did want to join our community, you can do that very easily. You can find out more at pensioncraft.com/membership, and I think that's a great way to learn about investment. And, as always, thank you for listening.